LVMH, Moët Hennessy Louis Vuitton. We all know it, right? It's the absolute heavyweight champion of the luxury world, led by Bernard Arnault, Europe's wealthiest man. And honestly, if you look at this empire historically, it's just been a story of relentless, staggering growth. But as we dive into this explainer and look at the most recent data from August of 2026, well, the champagne isn't flowing quite as freely as it used to. The company just reported their first half earnings, and while they did beat analyst expectations, make no mistake, we are looking at a definitive slowdown across the empire.
And I really want to anchor our entire explainer today with one specific number, plus 7%. We're looking at a 7% organic growth rate for the first half of the year. Now, let's be clear. By any normal corporate standard, a 7% bump, that's a highly solid number. But LVMH is not a normal corporation, is it? For them, this 7% is actually a far cry from those wild, double-digit hypergrowth boom years they saw right after the pandemic. The landscape is shifting, and the numbers are finally starting to reflect a brand new reality.
So, because of this shift, today we are cutting through the noise. We're going to do a completely impartial, data-driven breakdown of this luxury giant. We're talking verified financials, a really highly debated and controversial new retail acquisition, the strategic succession planning going on within the Arnault family, and yes, a few hidden ESG risks lurking right there in their supply chain. If you're trying to figure out where the world's most powerful luxury brand goes from here, you are absolutely in the right place.
Here's our roadmap for today. We'll check their H1 2026 financial health, dig into their retail bets, unpack how they're navigating succession, uncover those hidden supply chain risks, and wrap up with the final investor verdict. All right, Section 1, H1 2026 financial health. Let's check the vital signs of LVMH. So, looking at the raw numbers, out of a massive 45.6 billion euros in total revenue, LVMH generated 11.2 billion in profit from recurring operations. But here's the crucial nuance you really need to understand. The overall growth driving these numbers, it's entirely price-driven. Literally, they're just charging more for the exact same items. And when you factor in rising production costs, you can see that their margins are actually under quite a bit of pressure, even with that massive 11.2 billion profit. We're seeing fashion and leather up 9%, but wines and spirits down 12%.
And wow, doesn't this just brilliantly illustrate the massive divide in consumer demand right now? I mean, on one hand, crown jewels like Louis Vuitton and Dior are up 9%, proving that ultra-wealthy shoppers are completely unbothered by the economy. But then, the spirits division, your Hennessy Cognac, your Moët Champagne, is just absolutely plummeting by 12%. Why? Well, we're seeing a really sharp normalization of consumption in the US market, and that's combined with a much slower than expected economic recovery over in China. Frankly, if this spirits division doesn't stabilize by Q3, we could easily see a downgrade in their full-year guidance. Moving on to Section 2, Retail Bets and Consolidation. Let's talk about how they're actually spending all those massive cash reserves. The biggest news of August 2026 is this totally aggressive 2.3 billion euro takeover. They bought a controlling 65% stake in the historic French department store Galeries Lafayette. Now, you might be wondering, why on earth would the ultimate luxury brand buy a department store? Well, it's a real estate play. They want to control a prime Paris lifestyle campus and literally block out competitors like Kering. But the investor math here is pretty staggering. See, LVMH enjoys a luxurious operating margin of around 24.5%, right? But traditional department stores, their margins are so notoriously thin, they're practically a rounding error. So by absorbing Galeries Lafayette, LVMH is intentionally diluting its overall group margins by roughly 1 to 1.5% over the next 12 to 18 months. It's a classic long-term moat-building strategy, but man, it creates a very real short-term headwind. But we have to contrast that short-term margin headwinds with a really brilliant piece of low-risk, high-reward consolidation. Just a few weeks ago, on August 10th, the EU Antitrust Commission officially cleared LVMH to acquire the remaining 40% stake in Bulgari. They basically cited that competitors like Richemont and Kering provide plenty of market balance, so it was good to go. For LVMH, owning 100% of Bulgari means they get to keep every single cent of those high-margin jewelry profits. And since jewelry is one of the fastest-growing personal luxury segments right now, having this acquisition fully baked is going to be a massive key earnings driver for them going into Q3. Okay, Section 3, Navigating Succession. Let's look at the future of the company. So, on August 14th, the 77-year-old patriarch, Bernard Arnault, orchestrated a major governance reshuffle. And the strategy here? It's honestly brilliant. His son, Frédéric, wasn't just handed the keys to the Louis Vuitton kingdom. Instead, he was promoted to head of the watches division.
Now, historically, that's been an underperforming turnaround project involving brands like Tag Heuer, Hublot, and Zenith. By putting his son in a position where he has to execute a really difficult turnaround and actually prove his operational mettle, Bernard is giving a highly visible, completely transparent roadmap to the market. And we all know markets hate uncertainty, right? So successfully testing the heir apparent actively reduces that key man risk premium that LVMH stock has historically carried. It's a very smart move.
Next up, Section 4, Hidden Supply Chain Risks.
Looking closely at their August 1st Life 360 report, the PR headline was fantastic. LVMH successfully cut their direct factory and store emissions, which are known as Scope 1 and 2, by a solid 24%. Awesome, right? But the material risk for investors actually lies in their Scope 3 emissions. That encompasses their entire supply chain, from leather tanning to cotton farming. And Scope 3 actually increased by 3%. This data just proves a fundamental truth about LVMH. Despite all the glitz and glamour, this is actually a heavy, resource-intensive industry that's just disguised as high fashion.
So, here's the crucial point on why that creeping Scope 3 number actually matters to the bottom line. It all comes down to the CSRD, the Corporate Sustainability Reporting Directive. This is an EU regulation that hits full enforcement in 2027, and it mandates incredibly strict carbon tariffs and deep supply chain disclosures. Now, to their credit, LVMH has pledged 300 million euros to regenerative farming to try and offset this. But listen, if those Scope 3 emissions continue to climb, this upcoming regulation could trigger some serious carbon taxes. And those taxes won't just hurt their PR reputation, they are going to eat directly into their gross margins.
And finally, Section 5, the final investor verdict.
Taking all of these diagnostics into account, LVMH is currently trading at roughly 23 times forward earnings. That is well below its 5-year historical average of 28. The market has essentially already priced in this slowdown. So what does this all mean for your strategy? Well, if you're an accumulator, you're likely viewing this as a prime buying opportunity on the dips. You probably look at that Galeries Lafayette acquisition not as a margin drag, but as a long-term fortress strategy that secures incredible distribution power for decades. But if you're a short-term trader, you need to exercise extreme caution right now. Your eyes should be glued to the Chinese economic data releases coming out next month. Because if the Chinese economy sneezes, LVMH catches a cold, and traders face a very real risk of a 5 to 8% near-term correction.
To wrap up our explainer today, the fundamental takeaway is simply this. LVMH is no longer a hyper-growth stock. It has transformed. It's now a mature, defensive giant, boasting a rock-solid balance sheet and a 1.8% dividend yield. The risks with their spirits division and those supply chains, they're totally real. But at the same time, their moat is deeper than ever. So I'll leave you with this final question to ponder for your own portfolio. Given the slowdown, the succession planning, and the massive fortress building they're doing, are you buying, selling, or holding LVMH? Thanks so much for joining me for this diagnostic, and as always, keep learning.